Good morning and welcome to this Wednesday, October 20th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've had quite a rally back off of those recent lows after the ABC correction. And currently, when I looked at futures anyway, maybe 10 minutes ago, it looked like we were going to have a mixed start, but mostly close to the flat line. Dow Jones futures down slightly. S&P 500 futures were flat. Nasdaq futures were up slightly. Crude oil down about $1 this morning, back down to about $82 a barrel after trading above $83 a barrel yesterday. Let's see, we've got, we'll be talking about the 10-year Treasury yield in just a bit, so I won't get into that. Overnight, we had Hong Kong stocks leading, some gains in Asia. Some Chinese tech stocks were starting to move a little bit there. This morning, really not much action going on in Europe, down just slightly on the DAX, about 0.1%. So the market's just going to get off to somewhat of a quiet start. And that's as earnings season really kicks into gear. We had Netflix report yesterday after the bell. The stock, actually, I thought the report was very good, but the stock's down a little bit. We had that big run into earnings, and that's some of the things, or one of the things that I've talked about recently that you see a lot. You get stocks that make a big run into earnings and then report what Wall Street's expecting to report, which was very good, raising guidance, raising subscriber guidance. Everything looked good in the report as far as I could tell. And the stock's down. I think last time I looked, it was down about 2% this morning, $12. So it's just the way the market works, you know. But if you bought the company yesterday into the close thinking you're going to get a good report, which you did, you're scratching your head wondering why the stock is not responding the way you would think that it would respond after a strong report. But again, that's just the way the market works. Let's go ahead and get into things here. If you are new to Earnings Beats, just want to point you to our homepage, earningsbeats.com. You can scroll down. You'll see Chartfest 2021. If you didn't get a chance to check that out, you can certainly just click on that link right there. It'll take you to the recording. I can tell you this was a 4-hour event. So it might be something you might want to spend some time looking at over the weekend or when you have time. But there are also a lot of shared chart lists here, right? You don't want to miss this because Grayson Rose and Dave Keller, who both joined me on Saturday, they work over at Stock Charts, and they provided a number of chart lists to help you in your routine. These are things that they do on a regular basis. They get into a routine, very habitual, and it shows. They're very organized. They know exactly what they want to do when the stock market opens, and they're prepared for whatever happens, whether we're up, we're down, stocks are up, down, whatever. They're prepared because they go through their routines. Both of them also are sharing a bonus, 5 stocks that you want to keep an eye on. So you want to check that out. And then Earnings Beats, if you're not a member at Earnings Beats and you'd like to check out, some of our research and the things that we do for our members, you can check out 3 different chart lists. So we have a short squeeze chart list, our flagship strong earnings chart list, and then raised guidance chart list. So 3 different chart lists you can download into your Stock Charts account if you have one. If you don't have one, you can view the chart list. You'll just have to view the charts one at a time, but you can still go through and take a look at what we do there. And then I also threw in my bonus 5 stocks to watch. So wanted to make sure everyone is aware of that. If you weren't able to attend Chartfest, it is still available. So go in and check it out. Take advantage of it. It was a great, great event. Really thankful that Grayson and Dave were able to join me on Saturday. Also at our homepage, if you're not a free Earnings Beats Digest subscriber, there are plenty of reasons to do so. All you have to do is type in your name, email address, hit that subscribe button. No credit card required. You can unsubscribe at any time. Published 3 times a week. It's a very quick read, couple paragraphs, 1 chart, just to give you some ideas about how we approach the market, the things that we look at that are important to us. And it also, being part of our community, just being part of our free Earnings Beats Digest community, you will be made aware of all of these free events that we have, like the one on Saturday with the Chartfest. So definitely check this out. If you're not already an Earnings Beats Digest subscriber, just a name and email address gets you in. All right, moving on to the market recap from Tuesday. So we had the Dow Jones Industrial Average up 200 points, closing at back over 35,400, not too far from the recent high that was set a couple months ago. The S&P 500 up 33 points, which was about 0.75%. And in about 4 or 5 very quick trading days, we've gone from the near recent low to back up near an all-time high. Not a whole lot more to the upside for the S&P to break out. Nasdaq up 107 points. All of these indices, by the way, these 3 key indices and the mid caps and small caps, all back above the 20-day and the 50-day. And you can see the 20-day on each of the major indices curling back up. Mid caps actually just saw a golden cross. Small caps saw it maybe a couple of weeks ago, but that's what we're looking for. We're looking for these golden crosses where the short-term moving averages climb back up above the long-term moving averages, because that's the configuration you need for an uptrend. You really can't uptrend if your moving averages, short-term and long-term, just keep crossing each other. That's what was going on with mid caps and small caps for months. So we want to see that golden cross. We want to see that 20-day move back above the 50-day, and then we want it to stay there. And as we go through the fourth quarter, this is historically the best quarter of the year, dating back to 1950 on the S&P 500. So I have reason to believe that it is going to stay there. But in trying to negotiate all that, I also need to point out October 21st, from the close that day to the October 27th close, those 6 days, that's the worst period of the year historically for the S&P 500. So I personally think a lot of it just comes down to options and kind of a buy on rumor, sell on news. So typically we get run-ups at the beginning of October heading into earnings season, and then earnings start coming out. And if you look right from the beginning of October, we've started to make this move. So right on cue with what the market historically does. And now we're a couple of days away from that October 21st. Actually, today's the 20th, so it's at the close tomorrow. So we got to get through 2 more days of trading, and then we'll see what happens. I mean, we're right up against resistance. So it wouldn't be shocking to see a little pullback here. Maybe we go back, test that rising 20-day moving average. Or maybe we break out and go higher. There's no guarantee. Just because the tendency is that we go lower, it doesn't mean that we'll go lower. So I use the historical patterns, the seasonal tendencies, as just an indicator. It's not a guarantee. I certainly don't trade strictly off of what has happened in the past. I'm much more interested technically in what the market believes is going to happen in the future. So don't confuse the two. I would trust my technicals first and seasonal patterns second. They definitely take a back seat. Anyhow, all of the major indices, though, did rally yesterday. Small caps barely up 1 point, mid caps up about 0.25%. So they lagged a little bit, but overall pretty good action. The other thing I just wanted to point out on the major indices is all the AD lines here on the 3 key indices, all turning back up with this move. So I'd be more concerned if we were coming all the way back up and we just kept going lower and lower on the AD line, but at least we are rallying on the 3 key indices. All right, then we've got sectors on Tuesday. So we had healthcare rising 1.3%, utilities 1.2%, and energy 1.1%. Those were your 3 leaders. A little bit of a turn in leadership yesterday. Healthcare and utilities, not exactly my favorites. Healthcare, I'm okay with. Utilities, don't really want to see that over an extended period of time. But we're going to see rotation from day to day. In a bull market, just about everything goes higher. We want everything to go higher. We want wide participation on moves to the upside. So it's okay for a couple of days for defensive areas to lead the market. What we don't want to see is the market breaking out, setting new highs led by defensive stocks, while aggressive stocks start moving lower. That would be a concern to me. Trailing yesterday were the consumer stocks. So yesterday they took a day off. Consumer discretionary has been on fire of late. One of the best areas in the market over the course of the last couple of weeks, maybe the best area in the market. but it did pull back yesterday about 1/4%. Staples, the second worst performing group, but did manage a slight gain, tacking on 3 pennies to 70.42. But trying to hold on to that 20-day EMA, which is now turned up. I think it's pretty clear, though, which consumer group has been performing better. I think if you look just here over the last few weeks to a few months, discretionary breaking out to an all-time high, while you see consumer discretionary, especially throughout September, selling off. So even though the September period was really bad for stocks, once again, that's kind of a historical norm. Look at the consumer staples and how hard this group got hit during September. And then look at consumer discretionary, which essentially went sideways for the most part. Had a couple periods of selling, but clearly the XLY outperformed the XLP. So is that a signal that Wall Street believes we've got bad stuff coming down the road? Discretionary stocks wouldn't be outperforming if we thought bad things were coming. So I think I take this relative performance in consumer stocks as a bullish signal that we're going to see higher prices. Just my opinion. All right, let's move on to the 10-year Treasury yield, give you a quick update there. Not much in the way of economic reports. We do have the Beige Book coming out today at 2 o'clock. This is a report of economic conditions, and normally it's produced 2 weeks before an FOMC meeting. So just something to watch to see if there's any big surprises in that report at 2 o'clock. So if the market, takes a big move, makes a big move one way or the other after 2 o'clock today, you might want to look to see if there was something relating to the Beige Book. But the Fed, I think, has been pretty transparent. So I would be really surprised if anything major came out in that report, but it's still a report that could impact prices this afternoon. The 10-year Treasury yield currently this morning down about 0.5 basis point. The trend remains higher. I believe we'll probably move back up into that toward 175 in time, probably at some point in the fourth quarter. And we'll see if we break out. The more and more I look at this, the more and more I believe that after this big rise in the 10-year Treasury yield, we're probably going to stabilize. I do think we could get up to 2%, 1.95%, test a high from a little while back. But I don't see yields taking off. I think we're going to consolidate this move up, maybe at 175, maybe we get to 195. But a lot of folks out there worried about inflation. I don't think inflation's a problem. I shared a chart with our members last night when I was talking about the different themes in putting together an ETF portfolio. We did that for our members. We announced the 10 ETFs that will be in our model ETF portfolio for the next 90 days last night. And one of the themes we talked about was inflation. So if we have a little bit of time, I'll try and pull those charts up for you as well. Very interesting charts, by the way. Let's move on, though. Let's move to talking technically. The S&P 500. What I did here is I'm showing you a 6-month chart of the S&P, and you can see the last 5 days. We were in this little downtrend, put in a hammer, and then the last 4 days have been straight back up. We're now challenging the all-time high. A move through 45.50 would do it. So it's less than 1% away. S&P 500 appears to me like it's poised to at least test that area, and then we'll see whether or not we can get that breakout. We might have to wait to get past that October 21st, 27th period. We'll see what happens there. Down below, what I've done is over the last 6 months, if I look outside of energy and materials, here are your 3 best groups over the last 6 months. Specialty finance, and this is the relative chart of specialty finance versus the S&P 500. So you can kind of see how they made their moves. Specialty finance has been pretty strong throughout, although we went through a little bit of a period of some profit taking second half of September, but we're starting to rally again. Insurance brokers have been almost straight up since the middle part of July. Very, very nice relative strength with insurance brokers. And then transportation services since the end of July have made a move. And I would say of the 3, this is the one that's been the most choppy. So you have really big moves up and then pretty significant relative declines, and then right back up again. And it's just been this constant back and forth, kind of nauseating. But the overall trend here clearly is to the upside. So these are the three groups that have been leading the S&P 500 outside of energy and materials. Keep in mind, energy and materials have very, very little influence on the S&P 500 because they're just not very heavily weighted. So yeah, energy and materials are doing great, but that's not what's driving the stock market. The stock market's being driven by other areas that are more heavily weighted. And these are some of the industry groups that have had an impact. The next chart I want to show you is the Nasdaq 100. Same chart, 6 months, rallying back, same kind of pattern. By the way, we talked about this while it was going down, expecting an ABC correction. There's your A, there's your B bounce, and then there's your C move down. And now we're right back up near high. Looks a little bit to me like maybe a cup on the NDX. It could be a left inverse shoulder, neckline, head. This could be the right side of a neckline that's slightly higher. Maybe we pull back to the 20-day. That's a possible pattern. Or maybe we just go right back up near those highs and just fill out this cup. I look for bullish patterns. I look for that in the midst of the ABC correction. I believe it's part of a continuation pattern. And so right now it looks like maybe a cup that we're getting there. Now down at the bottom here, I took the Nasdaq 100, which is the NDX, and I've put on here the 5 charts or the 5 companies that are components of the Nasdaq 100 that have led over the last 6 months. So these are the biggest winners on the Nasdaq 100 for the last 6 months. Moderna, and you can see the paths to getting there as well. So, and this is in order. Moderna has been the biggest winner. Then we've got NVIDIA. We've got Advanced Micro Devices, AMD. Intuit. I didn't realize Intuit was the 4th best over the last 6 months. Maybe that surprised you as well. And then Dexcom, medical supplies company, which is the 5th name on this list. So I probably could have guessed the first 3, Moderna, NVIDIA, and AMD, because they all had big runs. But the other 2 kind of were, I don't know, a little under the radar, I'd say. Now, their paths to getting where they are a little bit different. Moderna had that huge run back in July to August. Went from 225 to 500 in a month. That needs consolidation, and I think that's what we're getting here. You know, if you got in at 500 or 475, yeah, it's been a rough period as we've been downtrending. But that's a little bit of a lesson in not chasing, especially a stock that more than doubles in 30 days. It doesn't mean that it can't keep going higher, but you've probably heard me say you can't really manage your risk. That's the problem. You know, a stock like this, maybe it goes to 1,000, you know, before it hits, you know, rough patch. But what if it doesn't? It gets so far above your moving averages that where are you going to set your stops? I mean, even if you set a stop at 10%, you'd have been stopped out in 2 days. I mean, that's how violent the moves can be in both directions. So Moderna, I think, still a great company. It just ran a lot, needs to digest some of those gains. Is it done digesting? I don't know. I kind of think down into this gap support area around 250 to 275 is a possibility if we can't get back through the 20-day EMA, which doesn't appear on this chart, but we got close, but we didn't hit it. Also, you got this double bottom right here, maybe around the 360 area. We got up just over 350 or close to 350 yesterday, it looks like. But we need to get through price resistance. We need to get through the 20-day, and that's going to, you know, present some problems. All right, let me talk a little bit about those 2 inflation charts. So one was, if you want to pull up inflation on stock charts, what you can do is dollar. And if we want to pull up the producer price index, the PPI, I like doing the core because that's really what the Fed looks at. CPPI, $, CPPI gives you the producer price at the core, well, the core producer price index. Now, it only comes out monthly. So if you have a daily chart, it's going to look really weird like this. So what you want to do is pull up a monthly chart, volume, turn off, AD line, don't need that. And then on the monthly chart, let's go back 40 years. and just see what's going on here. And then what I would do is look at the rate of change, because the default is for 12 period rate of change. And on a monthly chart, that means 12 months. So this is going to give you your annual rate of inflation at the producer level. So if you pull this up, you will see down here at the bottom, PPI really starting to move up. I mean, we're now over 5%, 5.22% on a inflation rate. And you can see that's higher than anything we've seen since back in the early 1980s. So those who are talking about hyperinflation and inflation getting out of control and the Fed doesn't know what they're doing, this is what they're talking about. Now, I believe that it's the supply chain issues that are causing prices to go up. I think it's an imbalance in short-term demand versus short-term supply. Supply was cut off for a while. We shut down the economy for a period of time in 2020. We had restrictions. There just wasn't as much supply that was created. And then when we came out of the pandemic, everybody was out. They wanted to spend money. They wanted to do things. They'd been sheltered for a while. And so you have this unusual pickup in demand, incredible pickup in demand, combined with lack of supply because of the shutdown. Factories were closed, blah, blah, blah. And that imbalance is what's driving this inflation number up. I believe it's going to turn around in 2022 and head the other direction. But we'll see. Time's going to tell whether or not that is the case. But this is the CPPI. And notice again, right here, we're still going higher. So the inflation rate is picking up on an annual basis. Now, if we do the CCPI, which is the consumer price index, so this is inflation at the consumer level, and we update, similar, move up here recently, but notice that after we got up above 4%, which did not hit the 1991 high, by the way, but it has been the highest level since then, we've started to roll over. So I guess a question is, at the producer level, are companies at this point, because they're making so much money, I mean, just about every company is blowing away earnings estimates, it looks like maybe companies are deciding not to pass that along to the consumer, because we're starting to tick back down a little bit in the CCPI, the core CPI, whereas the core PPI keeps going up. So producer prices are rising still, but the annualized rate of the CPI has actually started to come back down. Now, will it take back off again? I don't know. But anyway, I just think that's interesting, that perhaps maybe what's happening right now is businesses are not passing along the inflation that they're feeling at the producer level. Something to think about. All right, let's talk a little bit about earnings, and then we'll wrap up with the three you must see. And what I'm going to do here is let's just pull up these as we go through and see what they're doing in pre-market. I'll give you their earnings per share. Netflix, 319 versus 256. They blew the number out of the water. Stock down $15 now, 2.3%. ISRG, little disappointing report here. Up, I didn't want to do that. Disappointing report here. Bottom line was $1.19. That was exactly what was expected. So no beat, which I was a little surprised. But market doesn't seem to care at this point. Down, 1/3 or maybe 2/5 of 1% here. But we would like to see the stock get back and close above the 50-day. So even though things don't look too bad at this point, we are trending lower. And until that trend changes, I'd like to see a breakout and a close back above the 50-day on ISRG. Next up is AMX. This is America Mobile. They missed 24 cents versus 32 expected. Stock down 2.5% pre-market. It's been downtrending since the peak a month and a half ago. CNI. National Rail did beat $1.21 versus $1.12. Stock up 3%. So that's a good move there. IBKR, Interactive Brokers, been trending higher. Pretty flat this morning. They beat 78 cents versus 75 cents. OMC, this is Omnicom Group. down 2.5%. They beat pretty easily, $1.65 versus $1.37. I haven't looked yet at the revenues or guidance on these stocks, so I'm just going based off of what I see on the earnings per share right now. As we look forward and take a look at the revenues, that will determine whether or not they get on our strong earnings chart list, because companies have to beat both revenues and earnings per share to get on there. UAL. So we got United Airlines up 1.7%. Pretty good beat here. The market was expecting a loss of $1.65. They came in with profit of $1.02. Or excuse no, back off, of a loss of $1.02, but the expectation was a loss of $1.65. So it was much better than expected, but still a loss. Nonetheless, UAL up 1.7% this morning. All right, turning to semiconductors, ASML reported this morning. This is ASML Holding, stock down 2% after beating expectations, $5.02 versus $4.69. I think probably we're just in this maybe period of consolidation. I'd be concerned if we lost about 710, 715 to the downside. Otherwise, we had this huge run, expect more consolidation, but I see the stock eventually going higher. Verizon, $1.41 versus $1.36. So they did beat, but the overall downtrend here, maybe we get a little bit of a pop with earnings, but really need to break that downtrend. ABT, this is Abbott Labs, up 4.3% this morning. $1.40 earnings per share, market expecting 92 cents. So pretty good beat there. NEE, 75 cents versus 72 cents. This is Next Era Energy, stock flat in the pre-market. And then one I was waiting for, ANTM. This has been a leader in its space in the healthcare providers group. And I've been waiting to see if earnings would be a catalyst to get this breakout above this triple top. We're right at 400. I mean, we're close. An open above 400, I think, would be bullish today. So this is one that I'd be watching here in the next few minutes. But ANTM 679 versus 635. CP, this is Canadian Pacific, down 0.4%. They actually missed 70 cents versus 75 cents. It's been trending lower, but I think that the railroads are starting to look better. And I think if the stock does gap down, I think this is one that could recover, because I think railroads are starting to look ahead and the market is beginning to price in better prices there. Then we got Biogen, BIIB. They beat 477 versus 415, stock up 1%. And to wrap up, I'm going to give you three more, but this is going to be the three you must see. So I'm going to look at, let's look at NDAQ. So this is Nasdaq OMX Group. Stock is flat. I'm going to pull up the chart here. They did beat $1.78 versus $1.72. The stock's been, priced for perfection, though, I think. So even though they beat, I wouldn't be surprised to see a 20-day test, but I'd be a buyer on the 20-day. I think stock looks pretty good. Then let's go to BKR as your second three you must see. Stock down 1.8%. They missed. Baker Hughes came up short. 16-cent profit. The market was expecting 22 cents. Stock has been up pretty nicely, breaking out above these prior highs. I'm okay on a 20-day test, so a slight pullback is fine. I'd be careful, though, if we closed back below the 20-day and the volume picked up. And then the last one I have for you is NTRS. This is Northern Trust. The stock is currently flat, up just slightly. They did beat $1.80 versus $1.67, trying to make this breakout at $1.22. Had it intraday just a couple of days ago back on Monday, but couldn't sustain it. And as I pull up the chart, we've been going sideways for a while, but again, we are trending higher. The volume's been picking up. I would want to see that rising 20-day hold on any pullback. All right, that is it from me. We're going to finish just before the market opens. I want to thank everybody for tuning in. Check us out over at earningsbeats.com. Make sure you check out Chartfest 2021, that recording, if you haven't already. You can go in and find that at earningsbeats.com. And while you're there, sign up for the EB Digest. Love to have you. All right, everybody, have a great day. Be back tomorrow morning over at Stock Charts TV at 9 a.m. Eastern for your next episode of Trading Places Live. Have a great day, everybody. And by the way, Tesla reports tonight. Happy trading, everybody.